I want you to picture two neighbors. Same street, same general age, same 40 years of working, paying taxes, and doing everything they were told to do. The first neighbor, let's call him Robert, spent the last decade before retirement reading every personal finance article he could find. He listened to the podcasts, he watched the videos.
Every expert he encountered told him the same thing. Wait. Wait as long as you can to claim Social Security. So he waited.
He turned 62 and kept working a job he had long stopped enjoying. He turned 65 and pushed through. He finally filed at 70, just like the textbook said, and he collected the maximum possible monthly benefit, roughly $3,800 a month. He felt proud of himself, disciplined, smart. The second neighbor, let's call her Carol, did something different. Carol claimed Social Security at 62. Everyone in her life told her she was making a mistake. Her financial advisor raised an eyebrow. Her son sent her a calculator link. She nodded politely and filed anyway. Her monthly check was smaller, around $2,200. On paper, Robert clearly won. Carol used those 8 years of income, all the years Robert was grinding, to pay off the last of her mortgage. She traveled twice a year while her knees still allowed it. She was present at her grandchildren's school plays, their soccer games, their ordinary Tuesday afternoons. She started a small garden business that brought in a little extra and gave her a reason to get up every morning. Robert, meanwhile, made his larger monthly check and spent the first 3 years of retirement recovering from the health problems that 8 additional years of workplace stress had quietly been building. His knees were worse than Carol's. He had missed things he could not get back. When you do the actual math across both their lifetimes, Carol came out ahead in ways that no retirement calculator ever captures. This is not a story about Social Security claiming strategies. It is a story about what financial expertise often gets wrong when it optimizes for a number on a spreadsheet instead of the life that number is supposed to fund. Let me start with a concept that will reframe how you think about Social Security for the rest of your life. The concept is this: a larger monthly benefit is not the same thing as a better retirement. Read that again, because every major piece of mainstream financial advice treats those two things as identical. They are not. They are related, but they are not the same thing. Here is how this confusion plays out across 4 dimensions. First, there is the obvious dimension, the monthly check. Waiting from age 62 to 70 increases your monthly Social Security benefit by roughly 76 to 77%. A benefit of $1,500 at 62 becomes something close to $2,640 at 70. Second, there is the time dimension. You have to live long enough to break even on the delayed claiming strategy. The break-even point, somewhere between age 78 and 82. Third, there is the quality dimension. Money received at 63 is not functionally equivalent to money received at 73. Your body is different. Your energy is different. Researchers who study retirement happiness have found consistently that early retirement years tend to deliver significantly higher life satisfaction than later retirement years. Fourth, there is the certainty dimension. A benefit you are already receiving is a certainty. A larger benefit you plan to receive in 8 years is a projection. Job loss, health events, market downturns, policy changes, any of these can disrupt the path between here and there. So when an expert tells you to wait until 70, they are optimizing aggressively for Dimension 1, while often dismissing Dimensions 2, 3, and 4. That is not bad advice exactly, it is incomplete advice. Now let's go deeper, because there are specific principles that the wait as long as possible camp consistently underweights, and understanding them changes the calculus entirely. Rule 1. The break-even calculation is almost always presented backwards. Most people think the question is whether you will live long enough to make waiting worth it. But here is the better question. What is the probability that you will live long enough?
Average life expectancy numbers are misleading because they include people who die at 50 and 60, which pulls the average down. The Social Security Administration estimates that a man reaching 65 today can expect on average to live until about 84, and a woman to about 87. They are averages. They do not know you. They do not know whether you have diabetes, heart disease, or a family history that runs shorter than the mean. Studies on health-adjusted life expectancy show a gap of roughly 10 to 15 years between people in the lowest income and health quartiles versus the highest. If you are in average or below average health at 62, waiting until 70 to collect a larger check is a gamble with genuinely uncertain odds, not the slam dunk it is marketed as. The financially honest version of the break-even analysis asks, given everything I know about my health, my family history, my lifestyle, what is my realistic probability of reaching the break-even age? Rule 2. The opportunity cost of those early years is real, and most calculators ignore it entirely. Here is what the standard wait until 70 calculator typically does. It compares what you would receive claiming at 62 versus claiming at 70, assumes you invest nothing, and concludes that waiting is better if you live past the break-even age. What it almost never does is account for what happens to the money you receive in those early years if you use it intelligently. Researchers have modeled what happens when early claimants invest even 20 to 30% of their benefits. The results consistently show that the break-even age shifts meaningfully later, often into the mid-80s, which is beyond what most people with average health will reach. Carol, our neighbor from the opening, used her early benefit to eliminate her mortgage. That is guaranteed return equal to her mortgage interest rate, with zero risk. Rule 3. Your health is data, not just a feeling. Most financial advice about Social Security treats health as a binary. You are either healthy or you are not. The reality is far more nuanced. If you are a 62-year-old with a serious chronic condition, heart disease, type 2 diabetes, significant obesity, the actuarial reality is that your life expectancy is meaningfully shorter. This is not pessimism. This is relevant information that you deserve to have when making this decision. Claiming early in that situation is not giving up. Conversely, if you are 62 and genuinely in excellent health, no significant conditions, non-smoker, active lifestyle, parents who lived into their late 80s, the case for waiting strengthens considerably. The principle here is that the advice needs to match the person, not the general population. Your health is data. Use it. Rule 4. The two-income household math is more complex than almost anyone explains. When both spouses have Social Security benefits, the claiming decision is not two independent decisions. It is one interconnected strategy. When one spouse dies, the surviving spouse receives the higher of the two benefits, not both, just the larger one. The standard advice is that the higher earner should delay claiming as long as possible because their larger benefit becomes the survivor benefit. A lower-earning spouse who claims early, collecting $1,200 a month from 62 instead of waiting for $1,700 at 67, generates real household income during the years the higher earner is delaying. Studies on optimal couples claiming strategies show that this coordinated approach, lower earner claims early, higher earner delays, often produces better household outcomes. Rule 5. Social Security income is not just income. It is insurance, and you are probably undervaluing the insurance component. Social Security is not just a retirement savings account that pays you back. It is longevity insurance. It is inflation-protected, government-guaranteed income that continues no matter how long you live. Industry data suggests that purchasing an equivalent private annuity for a 65-year-old would require somewhere between $250,000 and $400,000 or more. What this means for early claiming is that every year you collect Social Security, you are consuming some of that insurance value in exchange for immediate cash. You are trading future longevity protection for present income. The people who most benefit from delaying are people who have other resources, pension income, savings, part-time work that can cover living expenses between 62 and 70. The people who most benefit from claiming early are people for whom that income is genuinely needed now, who have reason to believe their life expectancy may be shorter than average. Rule 6. Taxes on Social Security benefits are a real and often overlooked drag on the delayed claiming strategy. Depending on your total income in retirement, up to 85% of your Social Security benefits may be subject to federal income tax. Single filers with combined income above $34,000 have up to 85% of benefits taxable. Married filers hit that threshold at $44,000. If you delay until 70 and receive a larger benefit, but your retirement income from other sources pushes your combined income above those thresholds, you may be paying income tax on a significant portion of that larger benefit. This video is for educational purposes, not financial advice. Every situation is genuinely different, and decisions about when to claim Social Security are significant enough that speaking with a qualified professional is worth the cost. Rule 7. The emotional and psychological cost of continued work is real, and the financial models do not capture it. Research into retirement timing consistently finds that people dramatically underestimate how much they value leaving work and dramatically overestimate how much they will miss their income. Studies in behavioral economics and retirement satisfaction have found that controlling for income, people who retire earlier report higher life satisfaction in their first decade of retirement. 8 years is a long time. From age 62 to 70, a human body changes. Knees accumulate miles. Backs develop opinions. The ability to hike a trail, play with grandchildren on the floor, take a long trip without worrying about recovery time. These things have a shelf life that your Social Security benefit does not. The financial planning industry optimizes for mathematical outcomes because that is what it can measure. It does not have a formula for the Tuesday afternoon you could have spent at your grandchild's recital. Rule 8. Need the money is not a shameful reason to claim early. It is a legitimate financial reality. A significant portion of Americans reach retirement age with limited savings. A substantial percentage of people approaching 65 have less than $50,000 in retirement savings. For many of these individuals, Social Security is not a supplement to other retirement income. It is the retirement income. Claiming at 62 because you need the money is not a mistake. It is a rational, human response to your actual circumstances. The financial shaming that sometimes accompanies early claiming, the raised eyebrows, the calculator links, the "you know you're leaving money on the table" comments, misunderstands the situation. You cannot eat a future break-even. You cannot pay your rent with a projected larger benefit at 70. Present necessity is a legitimate reason to claim present income. Rule 9. Policy risk deserves more weight than it typically receives. The Social Security Trustees Report projections have consistently shown that without legislative changes, the program could face a funding shortfall, requiring benefit reductions. Estimates have ranged around 20 to 25%, sometime in the 2030s. Does this mean Social Security is going away? No. It is the single most politically protected program in the United States. But some form of future adjustment is genuinely possible. People making the delayed claiming decision today are projecting a benefit 8 years into the future in a program that faces acknowledged funding uncertainty. A modest but non-zero policy risk is a legitimate input. It is not fear-mongering to acknowledge that receiving income now eliminates exposure to potential future changes. Rule 10. What you do with the money matters as much as when you receive it. The entire mainstream debate is framed as if the only variable is when you receive money, but what you actually do with the money matters equally or more.
Robert received $3,800 a month starting at 70, but Robert started receiving it after 8 more years of work stress had done their quiet damage. Carol received $2,200 a month starting at 62. She used 8 years of that income with the mobility, energy, and health that her early 60s still provided. She paid off her mortgage, eliminating a $1,400 monthly housing expense and generating an effective guaranteed return equivalent to her interest rate. When researchers study retirement satisfaction, the consistent finding is that retirees who feel they have control over their time report dramatically higher well-being than those who have more money but less autonomy. Time is the scarce resource in retirement. Income is the more abundant one. Now let's talk about what you can actually do with this information. This week, your job is simple. Find your Social Security statement. You can access it at ssa.gov by creating or logging into a My Social Security account. Your statement shows your estimated benefits at 62, your full retirement age, and 70. It also shows your complete earnings history, which is worth reviewing for accuracy. This month, the task is to do an honest health assessment. What does your family history look like? How is your weight, your activity level, your stress? You do not need a doctor's appointment for this exercise. You need honesty. Because the answer to when you should claim Social Security starts with a realistic read of your personal health trajectory. This quarter, build a basic retirement income model. A spreadsheet with 3 columns works fine. Model out 3 scenarios, claiming at 62, at your full retirement age, and at 70. For each scenario, list your monthly income from all sources: Social Security, any pension, expected investment withdrawals, part-time work, then list your expected monthly expenses. Consider a one-time consultation with a fee-only financial planner, one who charges by the hour, not by assets managed, who can stress test your assumptions. And here is the thread that ties all of this together. Robert and Carol made different decisions. Neither one of them was stupid. Neither one of them was reckless. Robert followed the dominant expert advice perfectly and optimized for the variable that the dominant expert advice told him to optimize for. Carol made a decision that most experts would have called suboptimal, based on a broader and more personal definition of what she was optimizing for. Robert's choice created what we might call a deferred life. He was always going to do the things he wanted to do once he hit the right financial milestone. The milestone kept moving. When he finally crossed it, he found that some of the things he had been deferring had a shelf life he had not accounted for. Carol's choice created something different. She built her retirement into the fabric of her daily life from the beginning. She accepted that the financially optimal path and the personally optimal path were not always the same path, and she chose the one that fit her life rather than the one that fit a spreadsheet. The cycle that Carol built was one of early decisions compounding into freedom. The cycle that Robert was drawn into was one of perpetual optimization, always one more year away from the perfect conditions. Both patterns compound over time. One compounds into a life you actually wanted. The other compounds into a life you were always planning to want. The choice, in the end, is simply whether you want to optimize for the retirement on your statement or optimize for the retirement in your life. Social Security is a tool. It is a genuinely good tool, inflation-protected, government-backed, designed to keep people fed and housed when they can no longer work. But like any tool, it serves you best when you use it according to your actual needs and your actual life, not according to someone else's model of what the optimal person in the optimal scenario should theoretically do. You are not a theoretical person. You are a specific one. Make the decision that fits that person.